I leave the word immediately to you, my friend Mauricio, to kick this off by introducing yourself. And by the way,
R-
welcome to this virtual spot. Glad to have you with us today, Bob. Thanks for showing up again. It's great to have the two of you here. Mauricio,
No,
introduce yourself, please, to
sure.
the audience.
Thank you. Thanks for having me, Andrea and Bob. Glad to be here chatting with you about all things blockchain. So, my name is Mauricio. I'm Brazilian. I've been working with blockchain related applications and business models since 2017. Had my first run into blockchain with the Bitcoin white paper back in 2014. So when I had the chance to work directly with the technology and its applications, I kind of never looked back. I have my own podcast called Block Drops, which I've been doing since 2019. It's a weekly digest about blockchain use cases, what works, what doesn't, and why the hell would you choose blockchain over anything else. So, I never skipped a week. So yeah, I don't have much of a life. Other than that, I also host Blockchain Insider, which is 11FS's crypto podcast, where I'm also the global strategy director for crypto, helping banks, fintechs, and regulators understand the implications of adopting crypto as the foundation layer for the future of financial services. And I also am a board advisor for a number of smaller early stage startups, which I use for my own research purposes as well. So yeah, and outside of business, I play drums on two different bands. One I have been with for 26 something years. The other one um, is a new musical project that we started a couple of years ago that we're kind of trying to flash out during the pandemic. So yeah, that's pretty much the Mauricio in a nutshell. But happy to be here, and thanks again for having me.
You know that you will be asked to perform, you see, your music sooner or later. Maybe not in
We'll
this
share
case,
we'll
but
share the links. We'll share the links with the audience. That's fine.
wonderful. I hope it's gonna be tough music, very tough one,
It's hard.
punky.
It's heavy metal.
It's heavy metal. Oh my goodness, headbanger. Anyway, yeah.
I was just thinking maybe you could create a nice intro tune for our videos, but
Well, I barely play the drums, so creating something that plays ahead of videos will be very challenging. But yeah, just pick whatever's ready.
Anyway, gentlemen, Mauricio, kicking this off, we we start from as usual, from the usual question. We exchanged several times some words about what's going on in digitalization of trade and trade funds. So we'd love to start from. We've seen many demises recently. We've seen many downfalls. What happened, in your opinion, and what could we do to avoid this to happen again? We
Yeah.
would love to
So
start from having your insights into
uh,
this.
many of the recent I want to say mishaps or bankruptcies or projects being shut down are by and large a consequence of a combination of two things. One is the chosen technology, and two is the chosen business model. You'll see a pattern of every one of these failed projects that have the same pattern. One, they chose private permission blockchains, which means that participants need to carry their own infrastructure, and everything becomes a fixed cost, and then you have the additional variable cost for operating and using the network. And because they use private permission blockchains, that means that people that are not part of the network but would want to use that solution or platform is now using someone else's infrastructure. And that creates a conflict of interest and obviously a disincentive for further adoption across a lengthier supply chain or chain or value chain, if you will. So that's one. The second one is the business model. The business model that was used by most of these projects was the traditional enterprise software business model with licensing and hardware and infrastructure and enterprise level costs, which if you are trying to reach deep into the supply chain, smaller players cannot adopt that because it's costly to them. So it creates a barrier to entry first and foremost. So if you dissect the projects that haven't been successful, this is what we learn from them. And obviously, you can't win all of the battles, but because we had so many of those cases being very well documented publicly, we now know better. And what I'm hoping to see in the next generation of solutions tackling this space with the use of blockchain is that they learn from these two characteristics and they choose better, more suitable, and potentially more sustainable as well business models, commercial models, and a set of technologies that will enable those business models to flourish. So that is kind of where I see these things heading now that we know better from these experiments that weren't as successful as they would have hoped.
So if I may summarize that, Mauricio, you basically say that they try to use very traditional business models, but use a completely new technology, which actually should be used in a different way. And then they could have been successful because now they create too high barriers and too many problems by using the new technology, while they could maybe use old technology because they use the old business models. Correct?
Yeah, and you don't need to be disruptive to an industry that doesn't need disruption. You want to be additional or accretive to an industry that needs additional features, right? So if you're starting with a new technology and you choose to use a old business model, you might end up having the same results because the technology is an enabler, right? Technology isn't the business model. Technology isn't the how. Technology is the means to which you will achieve the how. Now, you chose a technology that carries a lot of fixed costs. You choose a technology that requires non-network participants to volunteer their data to you as network participant. The incentive to participate is smaller because now you're volunteering your data. That is a very quote unquote Web 2 data in business model where you're volunteering your data for someone else to profit. And that is conflicting, right? Now, going forward, let's say we face and we finally understand that blockchains are transactional data infrastructure that should be used as public goods. Well, then you don't have the enterprise commercial model charging tens of thousands of dollars every month for someone to use that public goods, but you have a network of people that are being rewarded by protecting that infrastructure as validators would, right? And if it's permissionless, then anyone can build on it. If it's public, then everyone can see the data and give transparency to what's being transacted. If it's digital and 24/7, it can be operated from anywhere in the world at any day of the week. These are technology characteristics that now enable a business model that can be maybe pay as you go or pay as you use based on the type of asset that is now being transacted on a particular protocol built on top of that public good. So the way I see things evolving is that you remove the friction to adoption by using an infrastructure that not only everyone or everyone else is trying to use, so you leverage that infrastructure, but you don't create a vendor lock-in that you must join and be captive to that. And you can actually go and build your own thing. And because it's also composable, you can build more things on top of things that have been built already. So the new way of thinking of this is like we're moving away from economies of scale into network effects. If we try to apply old frameworks to new paradigms, well, now we know what's happened.
I think what you mentioned is really the issue, that the old thinking they try to use with new technology, while you have to have a completely different way of looking at basically the world around you, and to understand really the technology properly to be able to put forward the right business cases and use cases and to get the friction out we actually would like to solve. So it's only in one benefit.
Yeah, and you mentioned one thing that to me is paramount is what are we trying to solve? Right. So I was the reason why I keep my personal podcast without any sponsorship is because I want to keep independent, right? And I want to be able to actually tell the truth to my audience, like this is what happened. When we first had the NFT craze in the middle of the pandemic, a bike company decided they would issue a celebration NFT to the tune of £55,000. And it will be an NFT with the blueprint of a bike that was a combination of the best features of their 15, 20 best-selling bikes ever. And they would never produce that bike. So why would you ever do that? Why would you ever charge £55,000 for a blueprint registered on an NFT of something that would never be able to be produced? It's beyond me, right? So I went on and I called that out on the show, and I said, you know what, this feels really good that this is being called out, because I don't think anyone is actually saying that this is pointless, right? So I try to be as realistic as possible and maybe positively pragmatic, which is this is great, but it isn't great for everything. But for the things blockchain is really so, they're pretty unique. So I think that's the space, that sweet spot we need to find in most of the industries is like, yeah, we want to solve problems. We'll use a set of different technologies. And for particular use cases, blockchains are going to be the one technology that actually, makes bank, because it's the only one that really solves in the way that the industry is willing to operate from now on. What I think happened with the failed use cases in supply chain, trade finance, and international trade is that they were trying to apply an old framework using, or trying to tap into a new paradigm, which is the decentralized internet, and it didn't work. And now we know, better, and we can build better because of that. You might argue that these were expensive experiments. Yes. And because they were expensive and because they were experimented in public, we should be able to leverage from those lessons learned.
Which brings to the next question. They said we had failures, we had misses. Now we scoped potential reason for those failures. Leveraging on the hard lessons that we had, what, in your opinion, could be done furthermore to be successful, though? I mean, to bring to success, because from a trade finance professional, I can tell you the need for digitalization is there. It's evident. It's macroscopic. But to be successful, what can we do?
So I think a few things are happening that are different this time. So number one is legislators are now aware that they need to create frameworks that are new and that enable the use of these technologies, even if it's a little bit obvious. But I think that's moving. I think the one example in this industry that we can clearly talk about is the upcoming electronic trade documents bill here in the UK that's being championed by Lord Chris Holmes of Richmond, with whom I have the pleasure to work with on one of the white papers we wrote for Whitechapel Think Tank, which is a nonprofit volunteer-led organization I collaborate with here in London. And it's very simple. It's beautifully written. It's simple to understand, and it creates a legislation that says that now bearing documents can be operated in a digital infrastructure that is reliable and provable, meaning you can ensure possession of documents by these technologies. And this is NFTs 101, right? If you have an NFT of something, you have that something. That's possession on the age of the internet. So, and because the UK common law is used in around 80% of the trade finance contracts around the world, that means that once this bill is enacted in the law, 80% of these contracts in the world will now be able to tap into the possibility of having the corresponding bearing documents that they refer to as part of those contracts now transacted and secured in a digital form that would be then similar to an NFT. So imagine you have a bill of lading or a letter of credit that is now digitized, and you can actually create new process workflows across the world where you don't need a piece of paper flying around in a suitcase somewhere with, someone, scared of being stolen from it. And it moves faster because it moves at the speed of digital. So if you have legislators now thinking about unlocking the potential for the use of such technologies in different industries, you start to have a new framework that will create the ability to tap into this new paradigm. So that is one thing that I think it's different this time than it was up until late last year. The second thing is that more and more public blockchains are coming up with privacy or confidentiality protocols, right? The reason why most of the companies chose private permission blockchains is because they could select who would have access to that data, right? And that is important. Businesses are not made to be 100% public. There are pieces of information that create differentiated strategic advantages, and you don't get to open that data up to the world and not suffer the consequences of having your business hijacked by someone else, by a competitor, right? In commerce, in trade, you have terms and conditions that you as a seller practice with a buyer that are different from the second buyer and the third buyer. If they know what's going on, they can play that against you, form a cartel or whatever the case may be, right? You don't want that. So a portion of the data and a portion of the rules, the terms and conditions, will continue to need to be private. So now we have a few of the blockchain ecosystems actually coming up with privacy protocols, which is amazing, right? I'll give you 3 examples that I know of, and I'm pretty sure other ecosystems are coming up with their own versions of it. On the Ethereum ecosystem, Polygon Nightfall is now has now been made available. It's one of the efforts from the guys at EY, led by Paul Brody. I was with Paul recently. They announced Nightfall, Starlight, and Starfall, which are 3 components that they feel are going to take confidentiality on public blockchains to the enterprise grade level. I wouldn't doubt Paul for a second, so I think that's coming in, and that is going to be well adopted by industries. The Cosmos ecosystem has one of the IBC chains. IBC is interoperable blockchain, which is the protocol built around the Cosmos ecosystem. Secret Network is one of those chains, or app chains as they call it, in that ecosystem that is privacy first. And in the Cardano ecosystem, which is new to me, Cardano as a whole has been a recent point of attention to me, because the more people I know that are involved in Cardano, the better it looks to me. I even made a post on LinkedIn about the things I'm finding that they're building in that ecosystem, and they announced Midnight, which is a layer 2 aimed at privacy in the Cardano stack. So yeah, so public blockchains are now moving towards occupying that space that in the minds of the enterprise buyers, only private permission blockchains were able to deliver. But it's a different economic arrangement, because we know that public blockchains have their own economies of incentives to sustain the infrastructure that doesn't require you to pay, a high fee to actually hold the infrastructure yourself. So this creates more of an incentive for enterprises to actually go and look into those privacy chains and like, oh, I want to tap into that. Because if I can't do my data on a public good infrastructure, but my data is private, that is a great combination for my business, right? Because it has the right economic incentives and it has the right strategic incentives with the private data that can be transacted on it. So I think we're starting to see a combination of factors that will prove that we can do better on public blockchains with the right configuration for data privacy. And that becomes a very interesting proposition for supply chain and trade finance use cases as an entirety of an industry.
I heard also about you see subnets and wanted to ask you what you think of it. You know that I'm involved with the blockchain network, by the way, so wanted to hear your opinion about the interaction with subnets and mainnets, seeing the hybrid model.
I think the use of
course.
subnets, app chains, parachains, super chains, you name it. These are what I actually started chatting about this the other day on Twitter with someone. We're going to see a lot of fractal models or hub and spoke models on the future of blockchains. Because blockchains will continue to have the trilemma, right? The trilemma is the three-part dilemma between scalability, security, and decentralization. So the subnets will be a cut that is a little less decentralized, and they will serve specific purpose, but they will roll into a higher level chain that will take care of security and decentralization on their own, right? It's going to be a trade-off in terms of the infrastructure. I think it's a elegant engineering solution, and we'll also not see, again, if you're a hammer, every problem is a nail, right? So it's not going to be the solution for everything. Some higher value things will be likely to be held at a layer 1 or a layer 2 blockchain with less scalability, but more security and more decentralization for protection reasons. But I absolutely think that these are going to be a staple. And we'll see a lot of taxonomy coming out of the experimentation meeting. While in app nets or subnets or whatever nets or chains we want to call it at that level are use case specific. They might be even more private, but still public because they're running on public node infrastructure. So I think they are an interesting experiment. What will become a little bit hard when we start to like fractionalize chains like that is the governance, because you have to have a team of people maintaining that protocol, ensuring that the changes at a higher layer don't disrupt the lower layer. So governing that is going to become a little bit more complicated. But with the right channels and the right process, I think it's rather doable. As long as things remain public good oriented, I think there's a good chance that will happen.
So far, we focus mainly on technology, Mauricio, but the lesson I learned by talking to Chris Southwell, by the way, and David Manel, one of the two main guys involved with digitalization of trade finance in UK, is that if you don't follow technology in conjunction with legal and policy making, you get lost, you incur in roadblocks, which will hinder the whole product.
Yeah.
You have a privileged seat for witnesses what's going on with the ICC UK, with the Centre for Digital Trade. We all heard about Melissa, which is the model on electronic transferable records and the electronic trade documents. How will they fit into the picture that we just drawn? How are they going to step in as major game changer? We're all waiting for this because 15 more countries are going to be touched by those legal frameworks. Yeah. So, and the rest is going to come, by the way, at a global picture.
Yeah, remember, we can't have a global industry without standards, right? And I think MLATR serves itself as a standard. The ETDB, the bill itself, is a piece of legislation. It's not prescribing technology standard, right? It's rather the opposite. It's technology agnostic. So I think
Exactly. It's agnostic.
the work in standards will have to continue to exist. I don't think we're gonna. There's an ex KDC cartoon from ages ago about standards. I'll send it over to you later, and you can share with your audience. We will always have space for another standard, but how many standards can a global industry actually support, right? So I think if MLADR is a standard that we are globally willing to pursue, regardless of the legislation that says like, yeah, you can use MLADR and you can use resilient, provable cryptographic technology to ensure possession of bearing documents, and we can use that as a standard. That is certainly a quicker path towards adoption, because it's not only going to impact how things are can be built. It will impact how services and technology firms will interact with the technology, and then how the industry itself is going to interact with the assets that are going to be recorded using these technologies. So yeah, I'm all pro standards. I feel, when I say this, I feel less like the gen. So yes, I'm pro standards. But it's going to probably happen in a regional capacity, and by region I mean across particular corridors that have already great commerce, and they want to be better at commerce. And it might happen between corridors that don't exist today because the data isn't there and because they're not digital, and they find that, well, by adopting a standard digital electronic record, we can do more business because we couldn't before. Then that's another piece of incentive that we haven't mapped out yet, that says, well, now the commerce between North Africa and Central America is possible because they are operating on the same standards, and they have enough data to make sound decisions about who to fund and who to buy from. Well, this is what we want. This is the unlock that this technology promises. Is yes, we're going to see more of the global GDP unlocked, because now there's enough data for people to make decisions of how to fund and who to buy from, right? This is the expectation towards digitizing trade globally, right? And again, you and I have spoke about this before. We're at a stage of the potential impending recession and wars and economies and interest rates that we haven't seen before, and inflation. We don't have a recipe to get out of this, right? Printing more money isn't the recipe. So what is the recipe to increase global GDP and then maybe avoid a global recession? Is to find the pockets of efficiencies that we couldn't tap because we didn't have the technology or the data to tap into before. And the role of trade finance, international trade and supply chain financing in this moment in history is to find those pockets of efficiency and tap into that, withheld GDP that we don't have access today. Otherwise, we're going to print money, and it's only going to, get worse. But I think with the pieces of legislation we're seeing coming from multiple places, with global standards being discussed and agreed upon, we might have a shot at not having to print that, that much money, and then tap into those pockets of inefficiencies that we can now unlock with proper, again, it's all on the data. It's the technology's means for us to access timely and quality data. So yeah, I might sound a little bit more optimistic than what I really feel, but if we don't talk about it, then who will, right?
Absolutely. No, we have to be realistic in what we deliver. And we scope, by the way, together what could be a solution. And I agree with you, printing more money is the last solution, especially in nowadays conjunction. Talking about data, we go back to the digital space. Okay, so you know that we discussed several times in the past on a friendly manner, the two of us being on a custom talk. We discuss often digitalization, digital transformation. Is this the best way to go through this to achieve some results in a very reasonable lack of time, or maybe could we go another way of finding digitally native business models and paradigms?
Yeah, no, I like that. And at 11FS, we have a house view that things can go from analog to digital by digitizing things, right? But they can never be truly digital because this is actually turning paper into a PDF. If you turn paper into a PDF, are you really digital? Maybe not. But you can't run a smart contract with the data that's on a PDF. So we will need to be better at rethinking not only the technologies we use, but also the business models that we use to achieve those results. That is why I keep, babbling about new frameworks for new paradigms, because I think we're now on a potentially different decentralized paradigm that we haven't been able to tap into its entirety yet. But because we keep trying to replicate analog stuff on this new infrastructure, right? So if we have a bill of lading on an NFT, okay. But if we have the terms of a letter of credit on a smart contract, then we can automate so much more. So the use we make out of the technology is also different. You can say, well, I'm going to migrate my systems to the cloud, and then you just move the server. Or you can rewrite your application to benefit from all the microservices and the serverless computes and all of the good stuff that exists in the cloud. These are different paradigms and different frameworks, right? Same thing for business models. Are we going to just digitize trade and do everything we do in paper, but now on a system? Or are we going to actually embrace the new paradigm and build entire business models out of smart contracts? If they solve the problem, well, then let's do that, right? Because then we're all so much more efficient. So I think the discussion about analog, digital, and truly digital, or analog, digitized, and digital, is how do you set up an organization that embraces digital as its core tenet, not only from a technology point of view, but also how the interactions happen, how you bring on suppliers, how the teams work together, how the teams work in separate. How does a piece of the work that I haven't, known yet comes into my team, and now we actually go and compose on top of that? These are not technological discussions. These are organizational discussions. And it will require the trade industry to actually rethink what they want to look like in the future as organizations, not just on the technology front, but how the teams are going to work together. Remember, again, new paradigm. We're working on something that if we put on chain can be used by anyone else to build on top of. So if I put a bill of lading on the blockchain, can an insurance company come on chain and build a smart contract that uses the data from that bill of lading? Or even another bank comes in and writes a hedging strategy for the terms and conditions that are on that bill of lading. The possibilities are endless, but we as participants in the market will need to understand that once we choose to go that route, we open other avenues that we're going to have to deal with. And that means that it changes how we see compliance, it changes how we see risk, it changes how we see intercompany relationships and intracompany relationships. So are we ready to embrace digital as an industry? And who's going to do that first? So these are different imperatives in different layers of organizations that will need to face and adapt and evolve if we want to become a digital industry. Otherwise, we're going to be digitizing things and working off of PDFs that we maybe can print out write on them, scan it, turn them in a PDF, send somewhere else. That's just more work.
And that's what we already do.
Exactly.
And I completely agree. We have to adapt, transform different operating models, different ways of collaborating with each other, interacting with each other. Does that also mean, in your view, that actually finance will completely change because you use the word letter of credit? Will that still exist, or will be another type of financing method be available?
It brings furthermore the discussion, is it still feasible in 21st century to go through LCs, or maybe we should be finding through this different interaction for new products, more inclusive ones, because traditional ones so poorly inclusive. Think about how many small companies can afford going through letter of credit. It's total disparity. You have banks which have a massive bulk of knowledge, and they can do anything out of this. And you have small companies that cannot afford skilled people to deal with those. So it's totally unbalanced paradigm and way of operating.
Well, and not only that, I mean, think about funding, right? I mean, if you think about DeFi, decentralized finance, and I had this conversation with multiple clients, is that DeFi by nature, DeFi lending is a syndicated lending structure. People will provide liquidity regardless of where the money end up with. Why can we give a lower barrier to entry on letters of credit by pulling from the market without being constrained by particular banks? That will require different risks, assessment paradigms, but it's doable. And it's doable because we know it works in DeFi. Why wouldn't that work in a letter of credit instrument, right?
So and look at the advantages it would bring.
100%, 100%. And not only that, you now have access to capital all over the world. And that is really important, because my cost of opportunity in the UK is different from someone else's cost of opportunity in Brazil. That's different from cost of opportunity in the US. And maybe by bringing all of these liquidity providers together, there's a different blended cost of opportunity for the liquidity pool. So lending is better for them, and borrowing is better for the borrower as well.
And so what a huge advantage for small and micro companies that cannot tap into the finance.
Exactly.
I'll give you an example. In Northern Africa, it's impossible to get.
Yeah, I'll give you an example that's happening now in DeFi, which to me are the two examples actually of things that are happening that kind of speaks to the ethos of crypto, which is give people more access to finance. Credix and Goldfinch are two crypto startups. They do pretty much the same process. They source funds from developed countries, Europe, the UK, some countries in Asia, some North America, and they deploy that through DeFi. They deploy that to startups, to credit startups in Africa and Brazil and Latin America. So everybody wins. The lenders have access to a better return rate. The borrowers have access to a better interest rate. And the protocol takes a tiny bit of that difference in spread. Everybody in that supply chain wins. Now, it's a different type of risk management. The data that's available is different. The KYC and KYB and KY whatever are also required. And they are my very prime example of regulated DeFi. So if that can be done on a lending basis, that can be done on a letter of credit basis. We need to adapt. We need to embrace that, and we need to experiment that on top. And now you have that going on chain. We will have electronic documents bill enabling, a bill of lading to be on chain. Can you not combine these two things and create a possibility of lower barrier to entry for exporters in North Africa? I think you can. And I think we should. Because remember, the pockets of GDP are everywhere. We need to tap into those, right?
Why should a small farmer with a huge product, North Africa, South Africa, wherever you want, South America, you're from Brazil, I'm from Italy. So there's plenty of small companies there that deserve to be valued, and they do deserve to access international trade on their own without being at the mercy of somebody else. I think that it's peer-to-peer, this technology. So it cuts out so many intermediaries that are really dangerous. And you said we have to go DeFi. Decentralizing, 100% agree. But if you decentralize traditional stakeholders in trade finance transaction, what's going to be the role in this? And remember one more thing, is the URDTT that allows no traditional stakeholders to step in. So we don't only have to think about Melissa, we don't only have to think about the electronic trade bill, let's think also universal rules for trade transactions, guys.
Yep.
That
No, I hear you. But I'm not a decentralization maximalist. Okay, I don't think I'm maximalist of anything. Maybe heavy metal. But I'll give you this. Some intermediaries exist to benefit from the existing inefficiencies on supply chains in general. This is true in every industry, right? So if we start to unlock and tap into those inefficiencies and unlock that with the use of technology, some of these intermediaries will either reinvent how they operate in the new paradigm, or they will cease to exist. But if there are intermediaries that actually add value to the supply chain, they will become increasingly more efficient with all of the digital data that's going to be available to them, right? So if you're an intermediary that's playing those extended supply chains and you're listening to this and you're thinking, oh my God, I'm going to be disintermediated. Think about why your business exists. Does it exist to just benefit from the inefficiencies that are there already? Or are you actually adding value to the things that you do or to the clients that you serve? You can only be in one end of the spectrum. But I'm hoping you will find ways to, if you're just an intermediary reaping from the inefficiencies, understand the new paradigm and see where you now can add value. And if you're already adding value, understand the new paradigm to see how you can capture more value now that more data is going to be available, right? So it doesn't have to be peer-to-peer 100% to become, again, not every industry requires disruption. Right? Some industry requires added value. Maybe that is the case for international trade. So if you're an exporter that doesn't have access to funding, you should be pushing to understand what this thing means to you. If you're a bank that cannot access borrowers in that level of the economy, same thing. What type of new data that can come out of this new infrastructure should I use to price better my lending so I can access those exporters, right? Again, it's all on the data, and that's all it is. This is a data infrastructure. So yeah, happy to see this coming to fruition. And
we discussed this thing with the data, by the way, recently, Mauricio, with another friend of ours, by the way. Expansion of data, 100%. So reframing the lending also from a point of view, expanding the data access. Maybe, Bob, you can also answer into this because I know you're an expert. What other data can be brought in to expand this lending on both sides, both the lenders and the lendee? What could we do? Because so far, sticking to the mere financial data is proven to be totally elitarian, let me tell you, cutting off so many good enterprises. What's the direction to be taken furthermore through the blockchain, by the way, and through other related technology? I mean, I'm asking the both of you, not only you, Mauricio. So, Bob, feel free to answer as well.
You go, Bob. Let me drink some.
Okay, you can take a sip of your water.
I know I'm nasty and provocative, but that is my role.
Exactly. Now, I think what the technology will help is data fluidity. So it's much easier to have all the information being flowing through the whole supply chain. That will help a lot of different participants. So if you think about that, then you can have much more insights also for what we refer to also the smaller parties involved in the supply chain. If you have then insight that they have a buy and a sell, you see the payments as well, so you can create a little bit of a profile. What is their risk profile? How well are they dealing, and how well are they actually dealing with all the requests they have, and how well they actually support those requests. So with that, you can create a bit of a risk profile. Therefore, that it's easier for them to have access to liquidity as well and improve their working capital position. You can also think completely differently about current processes, which are now very, very linear. You can do it much more sequential. Not sequential, but parallel to each other, and much more speeding up processes. Because why should you wait until a ship arrives at the other side of the ocean to actually declare the goods already? You can already do it when the ship actually leaves the quay from the country of origin. So you can think about completely different things. And then also in conjunction with the help of IoT devices, you can actually have new data sources which you can combine. So you're not relying on this paper, these documents, which I also think is a manifestation of a certain event happening in the supply chain. You can have actually other tools to your present to actually verify that this really happened. So instead of one source, you might have several sources on that, and give also more trust to actually do already either a payment or an advance of a payment, etc. And then also the roles of the participants in the supply chain completely are different, because you have the liquidity pool, then your company or a protocol which actually creates a risk profile, and based on that, you can provide liquidity to another person or party. And then you can think completely about different services on top of that as well, because the technology is nothing else than, the first layer is the consensus model. Then on top of it, you have the asset layer, where you have the smart contracts and the tokenization possible. And on top of it, you have the applications. And based on top of that, you have an aggregation layer. So you can have all kinds of new business models, depending on what is being built on top of this basic layer, the consensus model. So if you have really good control of that, the possibilities are endless. Things we cannot think of right now, just as when the internet started, which are common now, they will happen as well.
Yeah, I really like that perspective, because the cost base for you to export something is still material, right? So if you can, and especially in the countries where the currencies are weak or devalued against standard currencies like the euro, the GBP, and the dollar, the cost that you have to carry is not only just the lending cost, but you also have the FX cost, and you have to hedge, because goods take a long time to go out of your factory down to your buyer's destination. So the hedging now is just a block of cost that is not variable. It's super heavy on the exporter as well, and it is for the buyer as well. And there's a lot of profit that the desks on the banks will make off of that hedging operation by itself. Now, if you can have the hedging to decrease linearly as data becomes available, provable data becomes available as the goods move from one point to the other, then you're actually reducing the overall hedging costs for the whole operation based on data. Now, if you're doing this based on a smart contract, then you can have a hedging smart contract do that for you, and you don't have to hold that on another desk position. You can actually have that on a hedging smart contract and run that on chain with the same on the same place you're handling not only the IoT data you mentioned, Bob, but also the NFT data that's holding the bill of lading and the liquidity pool where you're sourcing your funding from. So
Think
all
about
of
the
that.
traditional level of credit, by the way, Mauricio. This is
Exactly
the case. From the moment a letter of credit is being approved through the application to the moment it's released, to the moment it's notified, confirmed,
Yep.
Can take even years for, assets to the point where the letter of credit has been paid, because it could be paid also on expiry, different installments. there are so many points where you've been built, and you built in currencies, strong currencies. So again, it could
Well, it
double
doesn't, and the beauty of this is it doesn't need to be strong currencies. It could be on the issuance, the bill of lading issuance currency now. And if you have a
Exactly.
liquidity pool for that, then you can create the hedging smart contract to offset that risk as the goods move along. Same thing for insurance. Right now, insurance is a closed price. There is some, you know, thingamagic that they do to calculate the prices for the insurance. Now you have all that data on chain, and you might have variable costs for insurance. And it can be streamed. The premium to pay for that can be streamed as the goods move along move across the world. You can't do that with banking, but you can do that with the blockchain, right? That's what I'm trying to say. When I say that for things that the blockchain solve, it uniquely solves, these are the types of constructs that come to mind, right? And the more we embrace digital from the perspective of the business model rather than just the technology, more of those unlocks we're going to create. And you can say, well, yeah, you might not have the hedging revenue you had before, but now you have an insurance revenue that you didn't. And because you have more people exporting, your overall revenue as, say, a bank will increase because now there's more lending that you're doing with better data. So you're having less of a loss. So all of these levers need to be modeled before we jump into this for sure. But we need to the technology is available. Some of the legislation is starting to become available. What is preventing it? There's capital to experiment on this because VCs are here for that. What is preventing us from doing that in the first place?
Nothing, it's just a mindset.
That is the question. So.
You want my take on this, Mauricio? It's just waiting for the first mover, the prime mover.
Yeah, and it's true to me that the first jurisdiction that balances out the legislation that enables all of this to happen is going to attract a lot of talent, a lot of funding, and potentially a lot of prosperity. And I just hope I can make a little bit of my part to help that happening.
Could it be actually that the sustainability regulations are actually a way of putting this in a fast mode? Because they are more and more interested in following the products, following claims that there is no child labor involved, they're really green, etc., etc. Blockchain can play a role there again, and it's a product which is involved in trade. Do you think that actually could?
Yeah, I have one problem with what people call phygital, which is a challenge that IoT devices might help a lot trying to overcome. Moving things from digital to physical is easy. You can redeem an NFT into a pair of sneakers from Adidas, and the NFT ceases to exist. It's burned into a burn address, and then you can just go and grab the sneakers from the store. That's not a hard thing to do. The other way around is really hard. Getting something that is infinitely parametrical, like a physical good or a person or whatever, and turning that into a digital twin is really, really hard because there is not enough data in digital to capture everything that's unique about that thing, which creates a gap, and that gap can be exploited. So, yeah, IoTs are going to devices are going to help a lot of that. We need to be much more proactive in determining the standards and seeing practical use cases that incorporate them both. But I believe that is one angle we can come at this to expedite the adoption of truly digital trade finance.
Mauricio, we're coming up on top of the hours now, and this has been a wonderful conversation, by the way. And I cannot thank you enough for joining us, by the way. Could this be just the first one of other talks that we might have?
Yeah, happy to jump in the future and see. I mean, we can come back here after the ETDB is enacted and see how, you know, the industry has, you know, risen up to the challenge. But yeah, man, thanks for the invitation. It's been a pleasure. And thanks for the very hard to answer questions. Some of this really got me thinking.
Yeah, that's the goal. I mean, got people thinking. So thank you so much for being with us 2 days. And let's keep talking and acting, especially.
Yeah, thank you, guys. See you next time.
Thank you, Mauricio. It was a great chat. And hopefully our audience is very pleased with it as well. And if you have questions, please put them down and we try to phrase and answer them as quickly as possible.
Wonderful. Thanks, Bob. Thanks, Mauricio.